Hello all, welcome to my last video for chapter 5. This video is going to cover all of the remaining disbursement schemes, so just a little bit from each. So we have payroll, commissions, expense reimbursement, and register disbursement schemes. So let's jump right in with payroll. So payroll schemes are going to involve something relating to our payroll. So this could be fraudulent time cards, falsifying our hours, ghost employees, commission schemes. So we're going to talk about each of those three main categories. Again, ghost employees, falsified hours, and commission schemes kind of all go within this idea of payroll. So we're going to have some sort of falsified documents to get extra money through the payroll process. So ghost employee is someone who doesn't actually work for the company. So a ghost employee is going to be an accomplice of the fraudster or someone that doesn't actually exist. And that person is then going to get a paycheck for work that was never committed. So in order to do that, 4 steps have to occur. So first, the ghost has to be added to the payroll. So we have to add that person that doesn't exist. Then we're going to have some sort of timekeeping and wage information, how many hours they worked, how much the rate of pay that we're going to give them. So that's the second thing. Then we have to actually prepare the paycheck for this person and then deliver it to the perpetrator or the accomplice or direct deposit, whatever it might be. The funds have to get to that ghost employee. So how do we do each of these various steps? So adding the ghost employee. So that's whoever has the authority to add new employees into our payroll system. So this is typically going to be someone in our payroll account. Alternatively, they may have a terminated employee who doesn't actually get terminated, but then they just continue to pay that person and take those checks. We're going to have to collect some sort of time card information. So we may have false time cards, or we might have some sort of approval for a fraudulent time card that could also happen. Issuing the check. So after we have collected their time card information, we're just going to process the paycheck through our typical process, and then delivering those paychecks. So often it's going to be delivered to an accomplice to prevent suspicion, because if someone within the payroll department just takes that check, that would be a red flag. Oftentimes, we're going to want to have the control of hand delivering paychecks occasionally in order to help with that. So again, here we go into that, preventing or detecting these. So having the hiring function separate from other payroll duties. So the person who is authorized to add the personnel into our payroll record is separate from the person who's hiring them. The personnel record should be maintained independently of payroll and timekeeping. So as we've seen with all of these, the way to prevent them is to have good segregation of duties. Periodically check the payroll against our personnel records. So individuals who are getting a paycheck should be active in our personnel records and making sure that those two match. Run a report looking for employees who lack a social security number. We should have social security numbers for all of our employees, so that would be something to look for. We would also want to look for any terminated employees and see if we're paying anyone that we know has been terminated. And then, like I was saying before, the distribution of those checks should be independent of the payroll function. So you enter all the payroll, all those paychecks get prepared, someone else picks them up and distributes them and makes sure that we have legitimate employees picking up all of those paychecks. The next way that we can have some payroll issues is by falsifying our hours and salaries. So we could either state that we're working more hours, or in our payroll system, we can up the amount of our salary. So when we have manually prepared time cards, someone has to approve that you actually worked the amount of time that you did. So we could either have some sort of forgery of our supervisor's signature. We could also have collusion with the supervisor, where they're in on it and they're going to agree to sign off that you worked hours that you didn't, as long as you give them a part of the money. Rubber stamp, where the supervisor just signs off on your hours and doesn't even consider that you might have paid them for time that you didn't. A lot of time systems, time clocks now are going to be automated. So you could have someone punch in for you when you're not actually there. Rates of pay. This is typically going to be done by someone within the payroll department. So if we have increased that rate of pay in our payroll department, that could also help with overstating the amount of money that we are generating, so that employees get larger paychecks than they are supposed to. So if we have that employee personnel payroll record reflects their pay, that should be what we are ultimately paying them for in that paycheck. So we want to verify that the rate of pay that's in their personnel file agrees with the rate of pay that we're paying them for their weekly paychecks. So how can we prevent and detect this? Like I said before, I'm a broken record, separation of duties. So whoever is responsible for preparing our payroll is separate from the person who's responsible for authorizing your time, who's separate from distributing those paychecks, and ultimately reconciling all of that information. We want to have supervisor authorization of all overtime, sick leave, and vacation, making sure that they're not just rubber stamping. Verify all wage rates that are in our payroll system with that personnel file. Restricted access to approved time cards so that we don't have any forgeries or manipulation there. Supervisor should be present when time cards are punched, so no one can punch you in before you actually get there. So those are some things that we can do. The next one we have is commission schemes. So here we could have some fictitious sales. So when we have commission as a form of compensation that's calculated as a percentage of the amount of sales that the salesperson makes, that's going to be an area where we could have fraud. So the person is going to state they made a certain amount of sales so that they then could get more commission. So one way that they can increase their commission is they can have fictitious sales, somehow having documentation of sales that were never generated. They could also alter their sales. So again, having whatever documentation that we have that values or verifies the amount of the sale could get doctored to look like the sale was greater than it actually was. So either having fake sales or altering those sales documents. So how can we detect some commission schemes? We could do a correlation between our sales and commission expenses, because the sales should match or should be correlated with that commission. We can look at the commission by salesperson. If we have one salesperson that's frequently getting like 5 times the commissions of everyone else, that could be an area of concern. We could look for returns. So maybe they have generated a whole bunch of sales and then they ultimately get returned. Looking at that information. Looking at uncollected sales. So if we have a bunch of false sales that are now sitting in accounts receivable and then they never get paid, that would be another indicator that we have some false sales in there. Next, we have expense reimbursement schemes. So as the name implies here, this is when an employee makes false claims for reimbursement. So they're overstating their business expenses and trying to get additional reimbursement. So they can either mischaracterize an expense, they could overstate their expense, they could have fake expenses, or they could enter in a legitimate expense multiple times. So those are the 4 ways that we're going to chat about now. So a mischaracterized expense. So most companies are only going to reimburse certain expenses for your employees. So maybe travel, lodging, meals, but they might not have personal expenses while you're there. So we might have these personal expenses and we're going to characterize them as a business meal so that we can get reimbursed. So how can we prevent or detect these? So detailed expense reports where we are looking at each of those receipts and making sure that each of those charges are legitimate and that they are coded properly. Having policies that clearly state what we will and will not reimburse for so that it's clear to both the employee and the reviewer what we should be paying them for. The expense reports should be approved by their supervisor and not, again, thinking about the rubber stamped. We want to make sure that those expense reports are looked at. And also any expense that happens when the person is on vacation or not supposed to be working, that would be an indicator that we have an expense for a personal item and something that shouldn't be reimbursed. We could also have overstated expenses. So instead of getting reimbursement for personal items, here we would just want to get extra cash more than what we actually spent on those business items. So simply overstating the cost of an actual business expense. So you paid $75 for parking, but you said you paid $100 for parking. So you could alter those receipts, over purchasing, overstating another employee's expenses, throwing some extra things in there, orders to overstate expenses. These are different things that can be done to accomplish overstating or putting more on that expense reimbursement than we actually spent. How can we do that? We're going to want to look at original receipts. We're going to want to make sure they haven't been tampered with. Comparison reports to see any differences and looking for things that look out of the ordinary. We could also have fictitious expenses. So this is where we have expenses that never actually occurred. We're just making it up. So they're going to invent a purchase that needs to be reimbursed, but they really never did it. So they could either produce a fictitious receipt, they could have blank receipts from their vendors, claim the expenses of others. So someone else paid for something, but my client took me out to a meal, but I'm going to say I took her out instead of her taking me out, whatever it could be. We would like to see receipts for everything. We would want to scrutinize things that were paid for in cash rather than using a credit card, because a credit card can be traced back to where that came from. We would want to look for expenses that are consistently rounded off, so always a round dollar amount rather than something in change. So these are other ways that we can prevent or detect these fictitious expense reimbursements. We could also have multiple reimbursement schemes. So this is going to be the least common of our expense reimbursement schemes. And in this fraud, we'll have one expense, but we're going to submit it multiple times. So we had one taxi ride, but we're going to submit it 5 times. So how can we prevent or detect this? Again, we want to have original receipts. We want to look for duplicates. These are ways that we can prevent things from being submitted multiple times. The last one I think that we're talking about today is register disbursement schemes. So here we can either have false refunds or false voids. So in either case, when it's similar to when we were talking about skimming and cash larceny in the last chapter, these are things that are going to deal with our cash register. So The difference is that we have money removed from the cash register, but it's falsifying that transaction. And we have that money recorded on the register tape. So for example, in a false refund, we're recording the refund, we're recording the void, it just never actually happened. So that's why these differ from those skimming and larceny schemes we talked about last week. So the first one, false refunds. So if you work at a cash register, if you've ever worked in retail, when someone returns their goods, you'll process that refund. They'll give you their receipt. You'll put money back on their card, and you'll have some paperwork that shows that this refund happened, and then they'll give you back the jeans or whatever it had. So in a fictitious refund, we're going to process a refund as if someone actually walked in to return the goods, but we don't actually have any item for that refund. We could also overstate refunds. So maybe someone brought in their jeans and they had bought 5 items and they're bringing 1 item back. We could say that they're refunding the whole thing, only pay them back for the jeans, and then keep the rest. Similarly, credit card refunds, we could ring up the credit card refund, but then put it back onto our own personal card instead of putting it onto the customer's card. Any of these would be false refunds. Similarly, we have false voids. So here we're going to generate a disbursement from the register when a sale is voided. So we're going to have a legitimate sale, but then we're going to say we voided that sale and we're going to take the money out. So let's say someone comes in and they buy 5 pairs of jeans and it is $250. So they have given us $250, and after they leave, we record a void. So the void is going to be like, oh, this person decided they didn't want to have those 5 pairs of jeans, so that sale never took place. And then we could take that $250 out of the cash register. Typically, a void is going to require manager approval, but sometimes the fraudster could forge the manager's signature, or if they have their code, if the register requires the manager's code, they could have that code and type it in, or they could conspire with the manager to do this and have that information, or split the void or the refund. So concealing register disbursements. So we'll see inventory shrinkage. So we have in both voids and returns, we have goods that have left the building that are not recorded. So they either have not been returned and we record them as returned, or we voided the sale. So we're recording that they haven't left the store when they actually have. So we should see inventory shrinkage, because for both of those, we're going to have less inventory than our records report that we should. 2 methods to avoid detection: small disbursements. So doing small amounts of void. So instead of doing like our hugest sale of the day, we're just going to do like a $20 void or a $20 return. So having low disbursement levels. Also below management review level. So let's say management only needs to approve returns or voids over $100. Well, I'm going to do a return under $100 so I don't have to get that management approval. They could also destroy records so that no one has any identification that that even happened. So lastly, preventing or detecting these register disbursement schemes, making sure we have management approval for all refunds and voids is one thing. Obviously, we talked about collusion or falsifying that approval could have an issue. Cashiers should not be allowed to reverse their own sales. If I have to do a refund or a void, someone else should be required to do that. Making sure we have a customer receipt, always requiring that. Distinct logins for each employee. These are all methods that we can use to prevent these register disbursement schemes. Thank you for hanging in with me today. I'll see you next week for Chapter 6.